Taxes are going to be one of the biggest expenses of your entire life. But here's what most people don't realize. There are completely legal ways to dramatically reduce what you pay. This is a topic that interests a lot of people, but most never actually learn how to do it. They just accept whatever gets taken out of their paycheck and move on. I'm not a qualified accountant, but I've spent considerable time researching this stuff as someone who's had to optimize taxes for my own business ventures and investments. What I'm about to show you can save you thousands every year. Today we're covering the most effective legal strategies to keep more of what you make. We'll start with the basics that apply to everyone, then move into more advanced tactics for those ready to take it further. Just remember, verify what applies to your situation and get professional advice for your specifics. The biggest tax misconception. Most people have zero understanding of how income tax actually works, and this ignorance costs them serious money. Here's the misconception I hear constantly. I don't want a raise because it'll push me into a higher tax bracket and I'll make less money. This is completely wrong, and it's costing people thousands in potential income. Here's how tax brackets actually work. Let's use simplified brackets to illustrate the concept. First, $12,000, 0% tax. Next, $38,000, 12% tax. Next, $50,000, 22% tax. Everything above $100,000, 32% tax. If you make $60,000, you're not paying 22% on the entire amount. You pay 0% on the first $12,000, 12% on the next $38,000, and 22% only on the remaining $10,000. So your total tax would be $0 plus $4,560 plus $2,200 equals $6,760 in taxes, not $13,200. This is called a progressive tax system. You only pay the higher rate on the income above each threshold. Getting a raise will never make you take home less money. Understanding this alone can change how you think about earning more income. Strategy number 1. Maximize your 401k contributions. This is the easiest tax hack most people completely ignore. When you contribute to a traditional 401k, that money gets deducted from your taxable income before taxes are calculated. It's like that income never existed for tax purposes. Let's use real numbers. Say you make $60,000 and normally pay $6,760 in taxes. If you contribute $6,000 to your 401k during the year, your taxable income drops to $54,000. Your new tax calculation, $0 plus $4,560 plus $880 equals $5,440 in taxes. You just saved $1,320 in taxes by contributing $6,000. Plus, that $6,000 is now growing tax-free in your retirement account. If your employer offers matching, this gets even better. Many companies match 50 cents or even a full dollar for every dollar you contribute, up to a certain percentage. That's literally free money on top of your tax savings. The downside, this money is locked up until retirement. There are some exceptions for things like buying your first home, but generally you can't touch it without penalties. For 2025, you can contribute up to $23,500 to a 401k. If you're making decent money and not maxing this out, you're literally paying more taxes than necessary. Strategy number 2, change your earning structure. This is where things get interesting, especially if you have any side income. As an employee, the process is brutal. You earn money, get taxed immediately, then spend what's left. There's no room to optimize. But if you have a side business, YouTube, freelancing, selling products, whatever, you can earn through a business structure instead. Here's how it works. I set up an LLC for my content creation. All my YouTube revenue, sponsorship money, and other business income goes through this entity instead of directly to me personally. Before I pay myself anything, I can deduct business expenses, hardware equipment, computer, portion of my rent for the home office, software subscriptions, business meals, business-related travels. The list goes on. Let's say I make $60,000 through my business. After deducting $15,000 in legitimate business expenses, I only pay taxes on $45,000 instead of the full $60,000. Plus, business tax rates are often lower than personal income tax rates. Instead of paying personal income tax on everything, I'm paying corporate rates on what stays in the business. The key is keeping detailed records and only deducting legitimate business expenses. You can't just expense your groceries and call it a business meal. But if you're legitimately running a business, the tax savings are substantial. Strategy number 3, invest through tax-advantaged accounts. This strategy doesn't reduce this year's taxes, but it can save you massive amounts over time. Roth IRA contributions. You pay taxes on the money now, but everything that account earns for the rest of your life is completely tax-free. No taxes on dividends, no taxes on capital gains, no taxes when you withdraw in retirement. For 2025, you can contribute $7,000 to a Roth IRA if you meet the income requirements. Here's the math. If you invest $7,000 annually for 30 years and average 7% returns, you'd have about $700,000. In a regular investment account, you'd owe thousands in taxes on those gains. In a Roth IRA, you keep every penny. Traditional IRAs work differently. You get the tax deduction now, like a 401k, but pay taxes when you withdraw. Health savings accounts, HSAs, are even better. Tax deduction going in, tax-free growth, and tax-free withdrawals for medical expenses. The earlier you start, the more powerful this becomes. A 25-year-old maxing out a Roth IRA could easily have over $1 million tax-free by retirement. Advanced strategies for when you're ready. Once you've mastered the basics, there are more sophisticated approaches. Real estate investing offers massive tax advantages, depreciation deductions, 1,031 exchanges to defer capital gains, opportunity zones for tax-free growth. Backdoor Roth conversions let high earners access Roth IRA benefits even when they exceed income limits. Offshore accounts and international tax strategies, completely legal when done properly, but complex enough that you absolutely need professional guidance. Energy-efficient vehicle tax credits, solar installation credits, education credits. The tax code is full of incentives if you know where to look. But here's the thing, don't get overwhelmed trying to optimize everything at once. Start with the basics. Max out your 401k match, set up a Roth IRA. If you have side income, consider a business structure. Each of these strategies can save you hundreds or thousands annually. Combined over decades, we're talking about tens of thousands in tax savings that compound into serious wealth. Final thoughts. Most people pay way more in taxes than necessary because they don't understand the system. You don't need to be a tax expert, but spending a few hours learning these basics can save you thousands every year. That's money that can be invested, used to build a business, or just improve your quality of life. The best investment you can make is a few $100s for a good accountant or tax professional who can review your specific situation. They'll often save you more in taxes than they cost in fees. Every year you wait to optimize your taxes is money you're never getting back. Your future self will either thank you or regret the decisions you make today. Speaking of building wealth through smart financial decisions, everything I just covered works even better when you're actually investing the money you save on taxes. If you don't know how to invest yet, that's the next skill you need to master. I'll be creating a complete beginner's guide to investing soon, so make sure you're subscribed so you don't miss it. Your tax savings mean nothing if they're just sitting in a checking account earning zero. Which type of taxpayer are you going to be?